This
valuation
conference will now be recorded.
of this year, just so that some of you were also part of the same study group last year. So for the new entrants, we plan to organize a valuation lecture at least once a month, preferably on a Friday, which would be typically the last Friday of the month. This year it is expected that at least 4 sessions would be held physically at the BKC office, and balance would be carried out through virtual session. This being the first one, and because most of the responses were sort of hinting at having a hybrid session, we chose to carry it out via virtual session. Maybe once the July or the August session, we can start keeping them at the BKC office, right? As I've already mentioned on the group, in case you have any specific topics which you need to sort of get addressed or get clarified, you can let us know, and we will try to ensure that we have a full-fledged session on that particular topic. I have already received 1 or 2 topics for the future sessions, right? With this background, I will now sort of introduce Dev, who is the speaker for today. So Dev has been carrying out valuation since 2008. So he has been in the profession since more than 14 years now. Currently, he's a partner at Icon Valuation since 2014, before which for 6 years he was with Deloitte India's Bombay valuation team. Dev is a rank holder at both inter as well as final in the CA exams. He's also a registered valuer with IBPI, and you will regularly see him taking sessions at WARC Institute and the RVOs, right? In addition to equity and business valuation, he also specializes in valuation of intangible assets and exotic financial instruments like derivatives and interest rate swaps, right? So with this background, Dev, I would request you to start the session. Also, a request to all the members that in case you have any questions, feel free to write them in the chat box, and during the session itself we will try to clarify those questions. Dev, that is fine with you, right?
Yes, that will help. Let's keep it as interactive as we can, so as and when anyone has any point, they can just shoot through the chat box.
Yeah, only thing, we'll not be able to unmute the mics because otherwise it leads to some amount of chaos and confusion. What we can do, if someone has a question which it's not easy to sort of explain it on the chat box, we can keep some time at the end and we can unmute that specific person and he can explain the question over the phone, over the mic. Right?
That's fine.
All right.
Fine. So then I think let's start. Thanks for that introduction. Now, as you all can see from the topic itself, right, situation specific valuations is something that can actually cover a wide spectrum of situations and challenges that you might face in any valuation. So what we've done is we've tried to cover some of the key things that we might come across. Not unlike a normal business valuation, when you value let's say a stable company, you might come across companies which are either distressed or which are early stage or which might even be cyclical, or which actually might be just investment holding companies. So we've tried to cover how do we tackle challenges around valuing these kind of companies broadly. Now, over and above this, also either during the session or even at the end of it, if there is any other peculiar situation or challenges that you guys have been facing or you want us to kind of discuss and deliberate here, we are more than happy to do that. Let's keep it as interactive as possible. And the idea is to cover as many situations or challenges as possible, even from a practical standpoint. So even other than these, these situations, if in practice, if you face certain situations which you would want to kind of discuss how to tackle, let's go ahead and discuss and deliberate those as well during the session and towards the end of it. So as I mentioned earlier, right, usually, I mean, in a normal kind of situation where you will do, you kind of carry out a valuation, you will generally not face too much challenges if you're valuing a company which is in a proper mature industry, which is not cyclical, which is also a business that is kind of established and, at a stable state, and it doesn't have any other, say, investments in that sense and has its own operations, right? And is also generating cash flow. So this is a typical scenario where a lot of the challenges that we are going to discuss today is not going to come in or exist. But in reality, what happens is when you kind of go about doing valuations, some of these factors or all of these factors are not actually applicable, right? So we will look at what could be the situational challenges that come across, and then we'll kind of discuss in detail each of these situations or challenges, right? So one could be that the company that you're valuing is actually an early stage company, right? So in these kind of cases, you have typically a very, less amount of financial track record in the past, so to say. So the kind of methods that you use, the kind of information that is available is very different than what you would have when you're valuing an established business. So there are various methods that are generally applied in these kind of cases. Some of them are more from a theory or concept perspective, while some of them are more practical, which actually investors tend to use while evaluating these kind of investments. We'll also cover cyclical businesses or sectors, companies in sectors which are going through either, let's say, a peak or a bottom at the current time, and then we'll see how to tackle those by keeping the concepts of valuation methods similar to how we usually do, right? Even we'll look at kind of companies in distress, and when we say distress, it need not be like a IBC kind of case. We're kind of here we're trying to cover companies which are not doing that well, are facing certain challenges or headwinds in terms of, say, either cash flows or things like that, right? And last but not the least, investment entities, a very peculiar phenomenon that you generally would kind of take care of when you're valuing holdcos. So broadly, we'll cover each of these in detail. We'll also cover how do we use or apply basic valuation methodologies in each of these four scenarios. We'll start with the first one, we'll cover distressed companies. But before we go ahead, I think it's important for everybody here to note that this section is not to be seen from the perspective of what guidelines are laid down by, let's say, the IBC or the Insolvency Code, right? What we are trying to cover here is a normal company which is still under distress but trying to cope up with the challenges, and not regulatory requirements of valuation which are laid down under the IBC code. I think that's very important here, because otherwise you tend to kind of do it more what the regulations say. But here we're trying to cover a more practical aspect of any company facing these kind of challenges. How do we go about valuing those companies? So before valuing them itself, we'll have to look at what kind of characteristics are generally observed when you come across a company which is in distress, right? In general, the revenue might actually be, say, flat or declining. That could be an indicator that there is something wrong in the company, or it could be earning proper or growing revenues. However, the margins over the last 4 or 5 years have been shrinking due to various factors. It could be either due to costs not being appropriately managed. It could be due to heavy competition. It could be any of those reasons, right? Or they're doing well and they have a good kind of track record and trend in terms of revenue and profits, but they're not able to recover the money that is due to them from the customers. That is in fact one of the common starting points of any company that you see that might go on to kind of become an enlarged issue of distress, right? In terms of loan commitments, it's very commonly known, everyone is aware that when you have constant, say, debt repayment obligations or interest obligations, if you're not able to meet those, automatically it tends to affect your business operations very heavily, right? So that is another thing of valuing a company, which is where you're able to see that there is a trend where they're not able to kind of fulfill their loan obligations. That could be a sign that the company is under distress, right? Cash flows as well. Ultimately, all valuations are based on how much cash a company can generate. So if whether or not the revenues or the profits or the margins have been growing or declining, if ultimately the company is facing challenge in generating good cash flows, then that becomes a very important indicator on on the fact that the company might be under distress, right? Over and above that, there are always qualitative factors. When you actually discuss with the management, you tend to kind of get some feel of what the management confidence is about the business. So sometimes a lot of these above factors are not directly visible, but the management being in the business, running the business, is more aware that there are indicators of the above items, and hence the company might actually in the near future be facing challenges in terms of any of these headwinds, right? So that could be again another key indicator that you could look for. And however, most important is actually to understand that just because a company is loss making, it doesn't mean it's under distress, right? You will need to look at it more as a larger picture, where some or all of these metrics might actually, some or all of these factors might be relevant, and along with that, on the ground business, what are the headwinds faced, right? All of these put together is where you will tend to make a decision whether the company is actually under distress or not. It is not only related to the fact that the company is actually incurring losses, right? Before we get on to even valuation methodologies for these kind of companies, certain indicators more from a statistical sense or an economic sense, if you were to call it that way, is there are certain scores that people tend to look at, right? So Altman score is one of the metrics that people look at to see whether this company is likely to go bankrupt or likely to be under distress in the near future. So there are certain factors that has been laid down in that. The formula is actually there for you to see, which covers various things like working capital, assets, retained earnings, the profit margins at EBIT level, the fair value of the company, the turnover ratio, and then there is a mathematical formula laid down there. As you can see, 1.2 into working capital on total assets plus 1.4 into retained earnings on total assets, and so on and so forth, right? You will be even able to find some more gyan on this even on Google right now. Once you do that, you come up with a score, and what this theory indicates is that the firms with score of below 1.8 are the ones that are more likely to go bankrupt, whereas the firms which have a score which is above 3 are the ones that are not likely to go bankrupt. So if ever, irrespective of all the factors, qualitative factors that we discussed on the earlier slide, if we want to do a statistical or a mathematical analysis to kind of come up with a conclusion of, in which bucket does our company lie, then this is one of the ways that can be used for that, to see what the score comes up for the company, and based on that, whether the company is likely to go under distress or not. This can be used not only for valuation, but even if you're in a way advising the client from a business sense as to what are the decisions and where to take the business model going forward. This could also be an important input in those kind of advisory inputs that you can give to the client. Why do traditional valuation methods not directly work in case of distress? Anybody here would like to kind of give some thoughts on why a normal, say, DCF or a multiple may not actually work in case of a company under distress? You can just put it in the chat box. Anybody? No certainty about cash flows. There's no future to be projected. Yeah, there might be a future, but it might be more uncertain than, say, a normal stable business. Going concern assumption, yes, that's very right, because in fact that's the key point, because most of the methods that we tend to use in a normal stable business revolve around the going concern concept, right? And that might not directly be applicable for a company under distress. I mean, if you were to kind of take it approach by approach, income approach, which is basically the DCF, is where you look at a certain period of projections as a primary period, and then terminal value based on a Gordon growth or whichever formula, right? Both of these inherently assume that the company is going to continue as a going concern for the foreseeable future. Even if you look at a multiples based approach from a market sense, that also kind of tends to assume that peers have a healthy business, the competitors are in a healthy business, and the fact that the company is a going concern, right? So, however, these assumptions like a going concern may not be fully applicable for a company under distress, which is why what we need to do in these kind of scenarios is keeping the fundamentals of the methods intact. We need to kind of fine tune them to ensure that we are considering the fact that the company is under distress. The concepts remain the same. Income approach still remains an income approach. It still remains based on future cash flows. Market approach still remains based on market benchmarks. How you take those benchmarks or how you consider those benchmarks might be fine-tuned because of the fact that this company is under distress, but the concepts will have to remain the same. And hence, if we were to kind of go a step further and look at how can we adjust those methodologies? So when you're tending to follow a DCF method, there are two ways of doing it. One is within the DCF technique itself, you modify it. How do we do it? We'll look in the future slides. The first option is you do a modified DCF where you actually modify the technique itself to consider or incorporate the fact that the company is under distress. Whereas the second approach there could be that you do a normal DCF as if the company is, is well and there are no signs of distress. And then at the end, you have certain adjustments that you make to account for the fact that the company is under distress. That's under the income approach. Similarly, under the market approach, if you were to do something like a multiples, again, there are two options there. One is you modify the technique or the approach itself to consider and incorporate the fact that the company is under distress. Whereas the second option is you do a normal CCM or a CTM or whatever you call it, and then at the end adjust it for the fact that the company is under distress. So broadly, those are the ways how you can actually tackle. We'll cover each of these in the subsequent slides. Modified DCF, which was the first one that we saw, is the first option where you can look at, where although there might be, this may not be a case where you will be able to kind of say with certainty what is the likely projections of the company. So the next best option there could be to actually, kind of do a sensitivity in terms of scenario analysis, right? You could look at different scenarios for the business, whether optimistic, realistic, pessimistic, whatever, based on the assumptions of where the business might go under the distress, right? And in each of these scenarios, you might want to actually do a projections, or the management will be able to, help you the underlying assumptions. If things go well, then this is how the cash flows will look. And if things do not go well, then this is how the cash flows will look. And then you estimate the cash flows under each of these scenarios. And the next step further will actually then be to assign probabilities to each of these scenarios. Now, you might actually not be in a position to estimate, say, 2 or 3 different scenarios in a lot of cases, but there are ways to kind of do it even in a simplistic manner. We'll also cover a high-level example in the next slide. Once you do that, sorry, what is it? Yes, basis of value changes the way we use the methods. That's right. Yeah, how to quantify adjustments, we'll come to that, Harshil. I think we have some sections on numbers and examples as well, so we'll come to that. Asim, if I'm not able to keep a track on the chat, maybe you want to just ping me or interrupt me in between. That's also fine.
Yeah, I will let you know. All right.
Yeah, all right. Thanks. And then, like any DCF works, once you arrive at those kind of probabilities and scenarios, there is obviously a discount rate that is required. So you arrive at that, and then a present value, right? Now, how do you arrive at a discount rate for a company under distress? So that becomes a very, very key input in these kind of valuations, because this is not a normal company. There are a lot of risks associated with this kind of company. So generally, there tend to be 2 options again to go ahead and do that. One is you look at arriving straight away the cost of equity for a company similar to us, which is a distressed company. Or the other option is you can look at arriving at a base cost of equity for a healthy company in this sector, and then to that you add on a premium for the risk premium for the fact that this company is under distress, right? The first one is pretty simple, as you would do in any normal valuation, but adjusted for the fact that the current company that you're valuing, maybe it has a lot of debt, maybe that's why it's under distress. So a lot of debt will automatically go and increase your equity risk as well. Those kind of things are automatically factored in whenever you look at, let's say, the actual numbers. You take a market beta, you unlever it, relever it for your company's debt equity, and those risk factors do get captured directly, and what you arrive at is directly your distressed company's cost of equity. Whereas under the second option, you tend to look at a more normative, cost of equity based on an industry CAPM kind of thing as a start point, and then you look at something called as a distress premium. Now, how do you arrive at distress premium? Again, becomes a very subjective thing. A lot of ways to look at it. Most common way that we've looked at is always, things like, if this company is under distress, and if it were to, let's say, raise debt funds or raise, borrowings from the market, because of the fact that it's under distress, it is likely that it's going to be able to raise borrowings at a much higher rate, right, than a normal company not under distress. So a typical differential between those 2 rates is generally an good indicator of what is the risk premium additionally to be ascribed to this company for the fact that it's under distress. So in an example, if a similar healthy company can, let's say, borrow funds at 10, but this company is able to borrow funds at, say, 16, it is an indicator that 6% could be, a starting point or a good starting point for the additional risk that this company should actually command in the discount rate that you use for the DCF. A very simplistic illustration here. I think one of the factors that will also come out here is that we need to look at the probability of success or the probability of the business sustaining over a period of time, right, in these kind of companies. Now, the company may survive for, let's say, 1 year, 2 years, but the more longer you assume, the harder it is for the company to survive. So you tend to, make estimates on future in terms of what is the probability of distress continuing, and indirectly what is the probability that the company will continue to succeed. And that is a cumulative probability, which means if there is an 80% chance that it will sustain year 1, and then given the 80% chance, there is 70% chance that it will sustain year 2, it effectively means that there is only a 56% chance that it will sustain till year 2. And that's how what you see there in the red line is the probability of success ascribed over a period of time. So if the distress is much more larger at the start point, you will tend to have an assumption where the period of projections might actually be lower, because you can't really see the company surviving beyond the longer period, right? And once you arrive at these probabilities of success, you will actually apply those to the base cash flows that you've arrived at to come up with probability weighted cash flows, because this assumes that once it goes under distress, then there are no cash flows that the company can actually earn, and hence what you've come up with is effectively the probability weighted cash flow ascribable to the company. This is another way. One of the other mechanisms you could do it is 2-3 different scenarios, optimistic, realistic, and all of that, and assign probabilities to those kind of scenarios. So there are different ways. There is no hard and fast rule here, but the concept remains that you're looking at the business in the sense that whether it survives or not. If it survives, how much can it likely make? If it does not survive, then how much can it likely make? And ultimately, a weightage of all those factors is going to give you some kind of expected cash flow, so to say, and those will be used to arrive at a DCF kind of value for the company. Example of discount rate similar to what we spoke. If you assess a CAPM kind of discount rate for a normal healthy company in this kind of business, let's say you come up with 17, and then you will need to add some kind of distress premium for that. So you can look at what kind of cost of debt the industry is having, say in this example 10, and this company can raise debt borrowings only at 18. So indirectly a distress premium of at least 8% might be ascribable in this kind of company. So you end up adding 8 to 17, and then the final discount rate that you use will be 25 in that example. So as a concept, yeah.
There is a question from Mr. Bhushan Ramani. What he's asking is in case of probability of distress, if the probability increases, would the cash flow decrease?
So cash flows and probability are not directly linked in that sense, because what you're trying to estimate is once the company survives, what is the probable cash flow of that business in that scenario. So it is basically the probability is the one that takes care of the fact that the company is going to survive or not. If the company survives, what it can earn will totally depend on the business assumptions there. Does that answer, Mr. Ramani? Still confused? Maybe you want to take it offline, I think, or towards the end we can put the mics on, and that might be a better way then. All right. Distress situation may have limitations on fundraising. How to deal with it? Yes, you're very right, which is why that's one of the challenges that you will face, not only in distress but in fact also in early stage companies, where a lot of these assumptions tend to be valid only when the company is able to raise funds. But when you're valuing a company at a certain point in time, there are certain assumptions that you need to make. If the company is in continuous need of funds, then you will need to assess whether they're able to raise those funds or not. And if suppose there is an uncertainty, or you believe that they may not be able to raise more funds, then the business plan has to be factored in such a manner that if they don't raise those funds, then what are the businesses or the financials going to look like? Unlike a case where you have confidence that the company will continue to raise funds over the next 2-3 years, then your business plan can actually show the multiplier growth using the funds that you're going to generate. But if there is a clear limitation, and if you're of the opinion that they may not be able to raise any funds, then the business plan has to consider, which is the underlying revenues, profits, capex, investment in the business. All of that has to consider the fact that the shortage of funds or the funds will not be available to be raised. So that has to get factored in the projections itself. All right. So we can then move on. This was an example of the first possible method, which we said was modified DCF. The other option we discussed under the income approach was adjusted DCF, where basically what you do is you do a normal DCF as if the company is kind of going to survive. Normal DCF will be based on actual realistic projections of the company from today going forward. So you have a certain value, assuming a going concern that the company will continue forever. And then you go a step further to make adjustments. For making adjustments, you then decide what is the probability that the company may not survive. And beyond that, now you'll have to apply that probability to something. So you need to estimate what could be the value of the company if it were to go into distress. And then that is one of the scenarios that you end up looking at. So for example, in this, what you will tend to look at is you have a DCF value under going concern, which is say 100. And if you think that there is, let's say, a 60% chance that the company will survive, then 60% weight will go to the DCF, which means effectively there is a 40% chance that the company will not survive. So the other half of the value will come from 40% weight ascribed to a distress value. Now, distress value in most of these cases is generally linked to the fact that the company will shut down and it will have to sell all of its assets, right? So which means your book value might be an indicator, or in a lot of cases actually some kind of haircut on the book value based on the nature of industry, right? It could be less than the NAV also if it's going to actually sell the assets under distress. So usually that will be asset based. You have a value based on that and you assign the respective probabilities to that. The weighted values of both these scenarios is going to effectively add up to what you arrive at, and that will be the value of the company under this scenario. A simple example here, again, without going into specifics of how the DCF value is arrived or how the distress value is arrived, you have a going concern value, you have a probability, and the other side is you have a distress value, which means if they were to kind of shut down and sell everything today, what will be the value? You have a probability, and then you have a weighted value based on that. So that's how, this is where you do a normal valuation and then you adjust it towards the end to arrive at a weighted value. Valmik is asking, from a valuation perspective, how does a valuer look at distressed holdco with multiple non-distressed operating subsidiaries? So can you throw some more light on that, Valmik, whether, I mean, if the holdco doesn't have any operating business, what is the distress all about?
Can I speak?
Sure.
So take for example like Island FS. Supposing the holdco was the CIC. So they have multiple road assets, power projects, and all. So supposing you were to value Island FS around the distress scenario, how would you look at Island FS when its subsidiary companies were kind of not distressed?
So that is essentially like a holdco valuation in that sense, right? So when you are actually valuing the underlying investments, those are not under distress. So underlying investments will continue to be valued as normal companies, right? Now post that, whether ILFS can actually generate or kind of encash those kind of investments or not depends on the situation of the case, right? That is where most of the challenge will lie, whether they're able to realize the value of their investments or not. And once they realize, whether that helps them kind of streamline their holdco operations or not. So that is where your weightages or those kind of things will have to come in at the holdco level. But the underlying businesses which are not under distress and they're operating independently might have to continue to be valued based on a normal business scenario.
So basically you're saying that every company will be valued independently and then it will be kind of the value will be captured in the holdco, like normally how it's done.
Absolutely. Because each company,
but will there be a kind of holdco discount after that, or
Yes, there will need to be, I mean, we'll cover that also in the last section, but there will generally be some leakage when you tend to realize those values. So how you tend to take care of that might be different options, but there'll be some leakage in that.
So,
Sure.
Dev, I have just one point in
Thanks.
such case of what Valmik suggested
Yeah.
was mentioning. I think so. There may be a discount which may be warranted apart from the holdco discount in terms of to say that you may not have enough time to market this asset for sale or the assets which are holding for sale, and there may be an additional discount which may be applicable over and above the holdco discount for sale of these assets. I may be wrong also, but that's what I thought could be the case for
Yeah, what
valuing a holdco company in case of distress.
Yeah, what you're saying is in a way true, Bhakti, because I mean, if you're going to sell the investments under distress, there might be a chance that you may not realize its true value, and there might not be enough time to kind of put in a proper bidding mechanism, or there are other companies who might want to buy it maybe at a discount to what it is really worth. But again, I mean, those kind of things will be much more subjective to incorporate
Yeah,
as
yeah,
compared to,
yeah,
let's say, a tax leakage, which might be more
yeah.
that way.
Right,
But
right.
that will kind of affect it. Again, it depends on how the valuation is going to be used for, because if you're doing the valuation to kind of advise them on how much they should realize, then the underlying business, whatever its worth is, will need to be kind of given, and then the balance generally gets taken care of in the negotiations between the parties.
Yeah.
Mr. Kulkarni is asking whether to work out perpetuity value in both approaches of DCF explained right now. So the second that we discussed, which is the adjusted DCF, where you can see on this slide, this will be based on perpetuity value because this is a normal DCF assuming the company survives. So when the company survives, there will always be a perpetuity value. Whereas in the earlier approach that we saw in modified DCF, what you're effectively doing is you're estimating the chances of survival of the company and the related cash flows. So there you might end up not taking a terminal value as well. Even in the example that we saw, the company was, the projections were only for a period of 4 or 5 years, because by that period, the chances that the company will survive are almost negligible. So in that example, you would not tend to take a perpetuity value in that DCF because you're trying to incorporate the distress factor within the DCF itself. Unlike in this example that you see on the current slide, which is based on a going concern assumption as a traditional DCF. Mr. Shah is asking, in this case where we are saying the value of holdco would be effectively some value of subsidiaries, won't the consol financials do the work here instead of separately valuing each subsidiary? So consol financials may be one way to look at it, but standalone and the underlying sum of parts might be a better approach, simply because of the fact that we discussed that realizing the value of investments is a challenge from an holdco perspective. When you do it on consol, you're effectively assuming that the holdco has direct access to realizing all the value of all the subsidiaries without any other leakage, which may not be true given the corporate structure, given that the fact that they can realize it only based on either some leakage or some, if they're going to sell it under a distress, they might actually sell it at lower. So there are a lot of these factors because of which they might not still be able to recover the entire thing on a realizable basis, which is why a standalone plus the investments might actually be preferable. Also, if I were to add to that, it also depends on, in a lot of these cases, you might find that the actual underlying businesses of the investing companies might be slightly different to each other, in which case you may not be able to club them into one as well. Although they might be in the same industry, but they might have different business models, underlying business models. So you might have to kind of anyway separate out each of these and value them separately and then add them as sum of parts to the whole. So we can then move on to the market approach based methods for valuing companies under distress. Here again, what we had discussed earlier was two: modified multiples and adjusted multiples. So under the modified multiples, what you're trying to do is you're trying to incorporate the distress in the approach assumptions itself, which means that if your company is under distress, you will tend to look at peer companies or comparable companies who are also under distress. And then when you look at those as a starting point, automatically what the adjustment has been incorporated to consider the fact that the company that you're valuing is under distress. These could be either listed companies, or these could even be, unlisted companies similar to you who have been, let's say, taken over by any other company recently because they were facing a lot of challenges, right? However, conceptually it's fine, but you might actually find a lot of difficulty in kind of getting comparables who are also under distress, and more important than that, the reasons for distress might be very different, right? Your company is under distress due to XYZ factors, whereas the other listed company, which incidentally, if it's also under distress, might be under distress due to various different factors. So they might not be directly comparable in that sense. So that is a challenge. But conceptually, if you're able to find a market benchmark of a similar company which is also under distress, you can just directly use those benchmarks and use those multiples and apply it to your company. That will tend to take care of the fact that the company under distress, what value it should command, right? So there is a question. When we build characteristics of distress and cash flow, do we still further discount the value conclusion under DCF? I'm not clear on the question actually. Can you elaborate? We will do a present value based on a discount rate. Is that what you're asking?
Am I audible?
Yes.
On the last slide, you discounted the value conclusion, the terminal value for probability of success as well as the probability of distress. My question refers to that.
Okay, actually that was not a discount. That's more of a weighted average kind of mechanism. So if I were to just go back to that slide, basically you have two scenarios. One scenario, the company survives, it's a going concern. And in this example, there is a 50% chance of that happening. Whereas in the other scenario, which is incidentally again 50% chance, the company will not survive. And if the company does not survive, how much can it realize from its assets? So there are two scenarios here. You have one value which is 1,25,000 here, and the other value is 75. Both are given probabilities, and the final value is a weighted value. It is not a discount to that value.
Okay, you mean to say it's like best case, and worst case scenarios that we generally do in case of DCF, and
Yes.
the weightages to that.
Yes, it is
Okay,
effectively like
understood.
saying company survives, this is the value. Company does not survive, this is the value. And these are the respective probabilities of both those scenarios happening.
Understood. Thank you.
Yeah.
Thank you.
So we discussed modified multiples. The other approach within multiples, as we spoke earlier, was adjusted multiples, where again, similar to the adjusted DCF, we will need to kind of do a normal kind of multiple and then adjust it towards the end. The only difference here being that since the company is under distress here, you might still need to do a valuation of multiples, assuming a going concern. So it may be very difficult at the current stage based on the current earnings and all that. So in most of these kind of cases, you tend to look at a futuristic multiple, assuming, let's say, 2 years later or 3 years later, what is the expected kind of earnings and what is the expected value based on that earnings. And that then you discount to today to come at a current normative going concern multiple based valuation, so to say. Once you arrive at that, that becomes a start point, just like the DCF we saw in the earlier slide. That becomes a start point under the market approach. And then the rest of the steps remain really similar to the adjusted DCF, where you actually have two scenarios. One is going concern, the other is that the company does not survive. You assign probabilities to both. One is a multiple based value, and the other is a asset based value, assuming if they were to sell off everything, how much can they realize. Both of these you'll assign probabilities, and the weighted value comes to whatever it comes to. So the only difference being the DCF on a going concern there will be replaced by a multiple on a going concern here, and multiple is most likely to be, will have to be done based on a futuristic concept, where you will tend to do it based on a future maintainable revenue, and you will tend to discount it for the period that you are required to, that is needed to reach that future maintainable level of operations. If you think, let's say 3 years, you'll discount it for 3 years, and then that becomes your start point under the multiple based value, right? So again, a similar example. I mean, you have a CCM value on a going concern, you have a probability, you have a distress valuation using NAV or maybe a discounted NAV or whatever. You have a probability there, and then the final value that you arrive at will be the weighted value of the company. So typically that was about distressed. Anybody has would want to discuss any other peculiarities you've observed in distressed companies? We can take it up now or even later, or any specific point you want to discuss before we
So
move
Dev,
on to startups.
I had a
Yeah,
question.
yeah,
Typically, what we have been all along sort of explained is that when a company is in distress, the minimum value that it can fetch would be the book value, right?
yes, yes.
How prudent is it to sort of use a multiples method or a futuristic earnings approach when the company itself is in distress? Now I understand you initially said that it is not for IBC, but whatever be the reason for the distress, from a say a regulatory standpoint or from an conservative standpoint, how prudent it is to use an income based or a market based method compared to a book value approach?
Yeah, in fact, that's a good question. But the point is, you're trying to ascertain the value. If it is clearly known that the company is not going to survive, then it's effectively like 100% distress scenario valuation, right? In which case you will tend to do in all of the examples that you saw only what it can realize, and that's the value. But we are here doing a valuation at a stage where it's still not clear whether they will survive or they might not survive. Now, at that stage, in fact, it might be more prudent to first take a step back and ascertain what are the chances of them surviving. And if you think there is some chance of them surviving, then that benefit should be given in the form of either a DCF or a multiple or whatever. And the very fact that you're going to be assigning probabilities tends to take care of the final value opinion that you give in terms of being prudent.
Right. So now for normal valuations, just the way we sort of check that, at least the going concern value that you are recommending is at least more than the book value. Now,
Yeah.
in this case, those kind of cross checks, do we have to be seen? For example, in the earlier example, you explained 60% of a going concern scenario and 40% of a distress value. So do we also need to check whether that 40% distress value is actually higher than the book value, or the end result is actually higher than the book value?
No, in fact, in a lot of these cases, the distress value might actually be lower than the book value as well, especially when you're assuming that the company is not going to continue operations and it will have to shut down and kind of sell all of these assets. Now, depending on the nature of these assets, a lot of times what they can actually realize, even considering factors like what Bhakti was also mentioning earlier, that you may not be able to realize given that you don't have too much time to market and do an informed kind of process, what you end up realizing might be lower than NAV also in that second scenario of distress. So in these kind of scenarios where you're actually considering that how much can they realize, then the book NAV might not be really an indicator of the final value. Then it is always a play between the probabilities and how much you can actually realize.
I have a question. This is Arsil here. So I
Yeah.
have a question. In case of distressed companies, what is the normal period we should consider for cash flows? Because what happens that company who are in distress, so maybe 1 year or 2 year. After 2 years, if they are not able to get sufficient cash flow, so in that particular case, it's highly probable that the company will go for liquidation.
So, there is, like in any normal valuation, there is no one normal period that you can actually ascribe saying we should take projections for say 2 years or 3 years or 5 years, right? It all depends on your visibility of the company and the management's visibility of the company. So if there are clear indications that there is no visibility beyond, let's say, a 3-year period, then you will need to kind of stop at that in that scenario where you're looking at probability of the company not going ahead, right? So in the example that I had in the earlier slide, you would have seen there is some 4 years or 5 years by which the probability of them surviving beyond that was minimal, and hence it was capped at that period. So you can tend to cap it, but how many years you cap it will totally depend on the kind of distress that the company is in and how much the management can actually foresee for the company going forward.
So actually, in a case of distress, the management is not willing to accept that, the company is actually in distress. and they keep on saying that everything is normal, right? It's a cycle that they are in. So the things would
No, I think it is, Harshil, very important. It is for us to understand that when we are talking of distressed companies here, we are not talking of companies where just they have maybe faced some challenges or competitive headwinds in the last couple of years, right? That's not what we're talking of in distressed companies. These are companies which are under severe distress, where they're not able to, there are, challenges on their survival itself. Unlike a normal company where there may be degrowth or there may be losses, that's not a distressed company. So whenever a company or a business is actually under severe distress, the management will be actually the first ones to realize that. Unlike, say, in a case where what you are saying, management usually will say that there is nothing wrong, where a company is, I mean, it's a stable business, but it's not been growing in the past 2 3 years, or it's been declining due to whatever competitive factors, the management will tend to feel that we have certain things up our sleeve, and we'll kind of tend to normalize it in a year or two. So it is very important for us as valuers to first try and understand whether this is really a distressed company at all or no, from a business sense, and then you go on to all of these kind of scenarios. Because if you and management are not not on the same page whether this is under distress or not, then that may not be the best starting point itself. Because it's very important to bifurcate companies who are not doing well versus companies which are under distress. Both are different.
okay. Thanks,
Yeah.
Kiran.
Anybody else? All right, then should we move on to startups then?
Yes.
All right. So before we go on to valuation methodologies itself, we'll spend a few minutes on generally what are the characteristics of startups and what do investors look for in them, and all. Those are qualitative factors which you might also need to keep in mind before you get on to valuing those kind of companies, right? So in most of the cases, startups are obviously new entities, and they're trying to solve something specific, some problem that they've identified. It could be through either products, services, platforms, or various dynamic models that you come across these days. And usually you will see that a lot of these new products or services will have some kind of element of innovation involved, even if they have to register themselves as a startup here, right? Now, when you go beyond that, I think before getting into the numbers itself, there are a lot of factors that we as valuers need to spend some time to look for in a startup, because all of these factors are going to determine your view on a lot of judgment related assumptions, like what is the risk associated with this business, how far do you think can they achieve these projections going forward. A lot of the factors, qualitative factors of the business, which the investors look for in startups, are the same ones that we as valuers need to spend some time understanding those kind of factors before we get onto actual numbers and methodologies and calculations and all of that. So on the idea itself, what would generally be looked at is it a new idea, or is it just has someone else kind of used a similar idea and you're just kind of modifying it and using a new idea? Or you will also tend to look at whether it is a specific problem that you've identified and you're trying to solve it, or is it more of a generic kind of phenomenon that there is there in the market and you're one among them, right? Are people facing the problem likely to accept it as a solution? So there are a lot of times when you will have doubts on whether this is the solution that the problem is being looked for, or is this an acceptable solution for the likely customers. So these are all things that investors will always look for, and similarly we will need to keep an eye on to decide how risky the business is, and to also get some comfort on the achievability of projections. Is it a disruptive idea, which is again very commonly seen? Do they have an early mover advantage, in which case it is more likely that they may be able to ramp up fast? If they are maybe the second or third kind of company, then it is very less likely, because as you would have seen, a lot of these high-end sectors or complex sectors, ultimately probably the top 2 or 3 survive and everything else moves in terms of consolidation, right? So if you're an early mover, then there are more chances for you to actually kind of grow exponentially as compared to, let's say, a third or fourth or a fifth player in that sector. Is a sector regulated? Again, becomes a very important thing, because the more regulations are applicable to the sector, there are a lot of risk factors that gets ascribed to that sector as well, right? You will need to also look at the promoters or the founders themselves. Are they trustworthy, and do they have the relevant industry experience or not, right? How many startups have they founded earlier and successfully exited? These are things that will tend to give more comfort on the business model and the realization of the future projections as well, right? Do they have a good management team to support their vision? So founders may be actually, having great experience in the industry and they would have done it in the past, but in the current setup, ultimately you would always require a good management team to support the idea, right? So you would also need to look at these kind of things to know, how good the company is and how far they'll be able to achieve. Do they have other businesses to divide focus? Sometimes you will also find founders these days have multiple businesses as startups, right? Now that tends to divide their focus, and you need to have some kind of confidence as to how much time is being spent on this business to ensure that this idea is in a way marketed and sold properly. Also on the business and industry, these are more commercial and qualitative aspects of whether the product itself is ready or is it under testing mode, whether it's going to be launched soon or is there still more time to be launched in the market. What is the pace of progress at which it is being developed? Is it in line with what was actually discussed when the product was initially put out for development? Are there any direct competitors to this, or is it that we are going to be the first ones in terms of a category creation there? How will the competitors react to the product? So a lot of times, the moment you launch a product and if there are already competitors in the industry, they might actually react maybe by, say, reducing the prices or launching other comparable products or whatever, which might tend to kind of again throw some more challenges on our business, right? How big is the addressable market? Now addressable market is very, very important because a lot of these factors that we saw even on the earlier slide, what's the idea, what is the problem, will the problem people have and accept this idea as a solution, all of that is going to determine the total addressable market. Unless the addressable market is large enough for companies to survive, it is very difficult for this early stage company to be able to ramp up exponentially. So one of the key indicators actually even investors look at is how big is the addressable market that the startup is catering to. In terms of funding, always important to see that before going outside to raise funds from investors, whether the promoters have put in all that they have. Because if they have more funds and if they're not putting that in the business, does that mean that they do not believe in the idea of this business, right? So that always is one of the first questions that you tend to ask them, whether as investor or valuer, is that before going out for funding, is it that we've exhausted our internal resources, or is it that we don't have those kind of funds and hence we're going out for funding, right? From a financial perspective, always we'll need to look at whether there is any visibility on when the company is going to start earning revenues. What are there processes internally to determine forecasts and then work towards them as budgets? When is the company going to start making profits? Will the business require more funding going forward? Someone asked some time back whether that could be a challenge. Obviously that is a challenge in a lot of these early stage companies as well. Will the company be in a position to continue raising funds if it is that kind of capital intensive requirement of the business, right? And if the answer is yes, then that will lend much more credence to the growth that you look for in the startup going forward, right? Those were all qualitative factors on what you look at while investing or while, say, evaluating a company. If you were to kind of take a step back and say what when do startups fail, why do startups fail for that matter? That's a typo there. Anybody here would want to throw some light on typically what is observed, reasons for failures of startups, general reasons? None? Talent plus funding. Yes, so talent is obviously very important because you need to have the right people to kind of help you ramp up the business, and funding is always important. I mean, funding is obviously one of the most important. Lack of a larger vision, failure to factor for the competition, that's right. Lacks innovation, willingness of the founder Focus on top line versus bottom line. Yes, that's also true, especially in a lot of these companies these days. So, I mean, there was a study that was done, and we have the results of that put up here. Over a period of time, it was studied as to why do startups, least lack of continued persistence. That's also one of the things. If you look at the factors here, I mean, the top reasons why startups fail: ran out of cash or failed to raise new capital is the topmost there. 38% of the cases were where it was due to funding crunch. And the next is actually very interesting. If you see, the next biggest reason is no market need, 35% of the cases. So no market need is something that it might be surprising that you see here, but it is very, very true in a lot of these cases where the market needs to require those kind of products or services, right? So the need has to be there. Only then will you be able to actually market and realize the true potential of what you're trying to sell. If there is no need for that in the market, then it's not probably going to survive. So a lot of these other factors that you see down below are more procedural and kind of elementary, and that's more commonly observed as well. But the top two are very critical here: fundraising crunch as well as no market need. So when you are evaluating models of startups, these two, the top two, are the ones I would say that we need to keep a specific eye on, to go one step further and understand in detail as to whether there is really a need for these kind of products or services in the market. And that will, the answer to that will lend us comfort on whether this will survive or grow or probably not, right? And obviously the fact that whether the company has the ability to continue to raise funds. A lot of these companies we've seen over the last few years that although they keep incurring losses, but they're surviving on the fact that they do have the ability to continue to raise funds, whether to fund the losses or to fund the investment for a future growth. Now that's obviously a matter of separate discussion, but to be able to survive, you need that ability to raise funds depending on the nature of the industry. So even if when you're evaluating the projections of a startup, if the projections show a kind of exponential growth, assuming that they will continue to raise funds, some kind of discussion on that needs to happen to ascertain the likelihood of that actually happening, whether they will be able to raise funds continuously over the next 2-3 years or not. And if not, as I said, then projections need to consider the fact that how much certainty is there on fundraising, and only to that extent the growth has to be factored in the projections from a valuation sense. Valuation methods for startups. We'll cover each of these in slightly more detail in the subsequent slides. Any reliable source for getting, sorry, what is that? Mr. Shah is asking, any reliable source for getting the survival success rate over years for companies, sector, industry wise. So there is no direct reliable source there, but there will be some, there are some reports that people have come out with which show the success rate of startups over a period. May not be sector wise, but on an overall startups, there are some reports which give you the survival rate based on the life of the company, especially in India. There are those, you will find them on Google. Yeah. So we'll then move on. So methods for startups, one is price of recent investment, where you look at the recent funding rounds. Then you can look at comparable transactions in similar space. There is also a method called venture capital method, which is usually used by investors. So there is one more point here. What is that? Rushabh. I guess market research is the most important criteria while ascertaining the valuation, and hence more emphasis on that might have to be kept. Yes, you're right. So market research also, I would put it under two buckets. One part of the research will have to revolve around the business aspect of it, and the other part of the research will have to revolve around the valuation aspect of it. So in both cases, market benchmarks or market studies, market analysis, market estimates, both are very important, especially when you're valuing these early stage companies. You're right. Discounted cash flows obviously is another method like in any other valuation. First Chicago is again another derivation of DCF. We'll cover each of these. And then there are certain qualitative based methods which tend to kind of ascribe a value just based on some qualitative factors and rankings and scorecards and all. We'll cover a few examples there as well. So one by one we'll go through there. Price of recent investment is obviously, as everyone understands, whenever you're valuing a company, the first thing that you tend to look for is when was the last round or last fundraising happened in the company, and what was the pricing or valuation of that round. That does become a start point in most of these cases for you to determine, what is the value of the company, right? If recently the company has raised funds, and if that is with an independent investor, that does become a very, very crucial benchmark as a starting point, as an indicator of the company's current value. This is one of the preferred methods. However, very important to note here is that there is a period up to which that value also will be valid. Now, in a very fast growing company, as is the case in most of these early stage startups, the value of the company based on the last funding round may be valid only for a very limited period. It may not be valid even, let's say, for a year or so. It depends on how dynamic the industry is and how fast the company's performance is also changing. So, in fact, that is the reason why many of you would be aware that even under the International Private Equity Valuation Guidelines, earlier price of recent investment was clearly one of the methodologies ascribed, but that has been removed now because of the fact that there might be changes that must be happening between the last funding round and the current date, and you need to figure out a way to account for those changes. Having said that, this does become a very, very important indicator of value from a practical valuation sense, because that gives you a comfort that an independent investor has priced a company at a certain value, maybe say three months before your current date. Also, another thing to keep in mind is between that funding round or last transaction in the company and when you are carrying out the valuation, are there any macro changes that have happened either on the business side or on the regulatory side? So, I mean, as an example, if let's say Walmart invested in Flipkart on a certain date, and let's say a month down the line, there are substantial regulatory changes which might need to ensure that Flipkart might have to have some minimum kind of domestic sourcing and those kind of things. Now, if that does change the dynamics of the business, then the value as per the last round also may not hold good anymore, and it will tend to get adjusted for all those factors. So from a concept sense, what I'm trying to drive is that just because the last transaction is, let's say, 3 months old, it may not be, it may not be a valid value of the company for that period as well. What you need to look at is all these kind of macro changes in the business environment or in the regulatory environment affecting that business as well. Another thing to look for as you would have seen, a lot of these early stage companies these days, they tend to issue shares of different classes. So each of these shares tend to have different rights. So if you are valuing a share which has a terms or rights which are different than what was issued in the prior round, then there might need to be adjustments to that effect, and it might not be a straight vanilla pickup of the value from the last round. So there are various ways to do that adjustment, but in principle, you will need to take that one step further to see whether that is valid or not. Going one step further is, again, as I said, because of the fact that there are various cases where you will tend to find that there are changes in the financial performance of the company, which means, let's say, post the transaction, the company has, let's say, doubled its revenue run rate or whatever. I mean, in those cases, the last funding round may not be really a indicator of the current value if there are such changes that have happened. So you will need to find out a way to tackle those kind of changes and to incorporate that in your valuation. And how would you do that? Is generally you would look at something like an implied multiple of the transaction. So which means the recent investment, let's say if it was done say 6 months back, and if the company was doing an X run rate of revenue, let's say at that point in time, you would then now tend to look at what is the company doing right now, and then let's say if it was 3x at that time, you would then kind of do an analysis to say whether the 3x should be more now or less now. Assuming it should be same, you apply the 3x to the current run rate of the company. So the value effectively gets prorated based on the growth of the company in that time period. So that's one of the common ways that you would kind of come across these days, where it clearly takes into account how the company has performed post its last funding round. However, also important to note here is that this kind of pro rata and implied multiples and all is not only valid when the company would have grown, it might be at the other way around as well. Post the last transaction, there might be a lot of headwinds that the company is facing, maybe liquidity crunch also from various angles, maybe competitive landscape has changed, maybe the revenues have declined as well. So if there are indicators of value declining post the last round, even those will have to be factored in. One of the ways to factor in is the implied multiple concept that we spoke of earlier. The other way could also be kind of just to look at the starting point of the deal value and then maybe ascribe subjective premiums and discounts and to come up with the current value. But generally, we tend to recommend it more like a multiple approach because that tends to clearly, quantitatively put the adjustments to numbers there. The next method under startups is comparable transactions, which is very similar to how you would do in a stable company as well. You would just go out looking for comparables who've got funding or who raise funds or where there are transactions, and then you would look at what kind of multiples they got transacted at. If you're valuing a pre-revenue company, you might have to look at multiples which don't consider revenue, but they consider other metrics like an active user base or any other qualitative metric ascribable to the business. Whereas if you're valuing at least a revenue stage company, you can look at a revenue multiple. Because we're talking of early stage companies, most of the discussion that we're having here is either at a top line level or at a qualitative, let's say, user base level or web page views or whatever. Because in most of these cases, you won't be able to, use a profit based multiple in any case because they won't be having profits at that early stage. Also, another important thing to look at here is, implied multiple means EV sales or price sales. From a concept perspective, if you're able to kind of benchmark EV sales, that is always more preferred. But you may not find actually that kind of data or information to kind of look at EV sales. So price to sales is also fine. It's a very accepted norm in the early stage companies as well, at least. And in terms of run rate, so as I said, so these are, most of these early stage companies are usually fast growing, right? So if they were doing an X revenue, unlike a normal stable company where you would tend to look at, let's say, a trailing 12-month revenue. Now, trailing 12-month might, in a lot of cases, might be, good benchmark here as well. But in a lot of cases, you will tend to find that month on month, they are growing multifold. In which case you might want to look at a more recent run rate, maybe a month annualized or maybe the last quarter annualized or whatever. That might give you a better sense of where the company is lying today. And what we have seen is actually when even investors look at these kind of companies and evaluate them for investments, they tend to look at the recent run rates rather than, let's say, a revenue over a period of 12 months. Because that the current last month or the last quarter might be, a better indicator of what the company is going to do in the over the next year or so. Key metrics that you could end up using here in a lot of these cases, one could be an annual recurring revenue. Now, based on the business model, you will come across companies which have, let's say, one is one-time revenue of, say, products sold, say, license sold upfront or whatever, and then there could be recurring revenue, which is more something that you can actually, project that it's a repetitive revenue. So a lot of times you'll find that deals are priced based on only the repetitive revenue portion, because that is something that the investor is able to qualitatively put a judgment on, that this is the at least revenue number that is going to continue going forward. So that was a question. In case of companies who are quite new to the market with a disruptive idea and being at pre-revenue stage, they don't have comparable companies in the same country. Is it fair to then compare them to foreign countries? Does not the demographics factors such a valuation? So if there are no companies in India which are comparable, it is always fine to go one step further and look for global comparables. But given the nature of industry, your adjustments from a foreign to come to an India might be very different. If you're looking at a regulated industry, then the adjustments that you make from a foreign multiple to an Indian multiple will be different. Whereas if you're in an industry where most of the countries tend to have similar dynamics, then the premium discounts might be lower in those cases. But if there is no benchmark in India, you can tend to look at foreign companies as a benchmark. The answer to that is yes, but only with a hint of caution. If the dynamics are very different for that industry, then you would not tend to look at that. What about KPIs? SEBI asked for inclusion of KPIs for new age companies in the DRHP. So all of these factors that we're talking of are effectively, some form or the other of KPIs, right? So it could be an annual recurring revenue or the other factors that we will see now. These are different kind of factors that you can look at while evaluating a company, which will give some comfort on the trends of the company and what they can achieve going forward. And the qualitative factors are obviously what we covered in the earlier slides as well. The other metric that people tend to look at, like I said in the earlier slide, is annualized revenue run rate. So maybe you can annualize the last month, or you can annualize the last quarter or whatever, instead of a traditional trailing 12-month kind of thing. Depending on the nature of industry, if you're looking at, if you're valuing, let's say, a platform where there are certain goods and services sold, like an e-commerce platform, which purely runs on, let's say, a platform fee, then investors also look at GMV, as you're aware, right? There are certain industries where you may not have maybe achieved revenue numbers, or they're so early that they're not worth applying multiple to, but you're having user base, right? I mean, for example, companies which are into, let's say, gaming, they will have they may not have too much revenues to show because in-app purchases may not have picked up yet, but they may have users who are every day logging onto their app, playing their games. So there will be a lot of data to suggest, what are their daily active users or monthly active users in those cases. So that also becomes an important benchmark in those kind of companies, where if that kind of data is available from a multiple sense, you can tend to look at that as well to apply a multiple. Gross profit, again, very rarely used, but we've seen it in some cases where business, not in services business, but in product related businesses, since they are revenue generating but not yet, let's say, EBITDA positive, you can do a multiple of gross profit as well, but it's very rarely used. I mean, in some cases it's done. Transactions, there could be always, merits and demerits that might be applicable here. Obviously, one of the biggest advantages is that you're looking at market benchmarks, and someone out there has actually paid based on those deals, right? So it lends a lot more credence to the starting point of the value itself. And as I said earlier, it's a traditionally backed method, low subjectivity, because the only subjectivity comes in the comparability and premiums and discounts, but the base numbers are coming from the market. So to that extent, it's a very backed up method, and you can always rely on it to give you a basic indicator of what would be a reasonable value of the company. Demerits, like always, more so in early stage companies, it is difficult to find close comparables, especially if you're valuing a company which is, let's say, the first in that sector, or which is creating a new category which has not been explored by other companies. In those cases, you may not find a comparable whom you can actually use, even unlisted for that matter, right? So that does become a challenge in early stage companies. One of the ways to counter that challenge is you can kind of larger the horizon and kind of take a broader sector view in terms of multiples, look at companies or transactions in the overall space, and then see what multiple they've got traded at. But then you would need to, kind of do more subjective adjustments to arrive at how good we are in this space as compared to the overall industry. Difficulty in finding data related to valuations of transactions is always there, because when you're looking at arriving at multiples of, say, unlisted comparables, there might be cases where you may not find their financials, or there might be other cases you may not find the deal values of those transactions. There might be cases where you may find both, but you may not get the stake that they've acquired. So that does become a challenge. There are certain databases which give you access to this kind of information, but in a lot of these cases, it does still remain a challenge. Again, the moment you're looking at using any financial metric, one of the things to be very mindful of is how different are the revenue models or the accounting models of both the companies, that is the comparable and the company that you are valuing. Now, if there are differences in how both companies, let's say, account for revenue, then that might be causing a lot of up and down in the multiple that you actually arrive at in the market and what you're going to apply to your own company. So that again is something that we have to deep dive into while choosing which transactions we're using, and to try and find out whether the models are similar or not. Non-financial metrics in cases where you use, like for example, as I said in the earlier slide, they are monthly active users, right? So if you're looking at using a comparable transaction based on such kind of soft benchmark, to be able to find that metric for the comparable company is a bit of a challenge. In some cases you might actually find it, but in a lot of the cases you will not be able to find it because it's not a financial metric, it's not a regulatory thing that gets submitted, let's say, to the MC or whatever. These are business metrics, and if they're available somewhere out there in some news article or their website or the deal announcement, then you can use that, but otherwise it does become challenging to source that kind of information. The next method under the startups, value startups, is venture capital method. Now, in most of these startups, what happens is that they are at such an early stage of the business now that currently there may not be too much available information that you can sufficiently rely on. So it becomes very difficult to kind of arrive at their value as of today. So this method, frankly, is used by a lot of investors actually in the practical sense to evaluate before they make an investment decision. So in their case, that's why the focus shifts to future value, where what you're looking for is initially to determine you're investing now, how much time horizon do you have before you exit the investment, what is the expected value of the company at that time. Let's say if you have 5 years, what is the company likely to be valued at that time based on whatever assumptions. We'll see an example on the next slide. Based on that, you tend to, and then you apply what you want as a return, as a required return, given that you are investing at this stage. Based on all of these metrics, you will tend to kind of do a present value calculation and then come up to what should be the current valuation of the company. And of course, all of this needs to factor in how much funds the company will continue to need to raise even to achieve that year 5 value, because there is a continuous need to raise funds. So the year 5 value, what you arrive at, and before you start discounting, that also needs to kind of consider how much funding you will need to raise, because the more external fund raised, your stake is also going to continue to go down in the future. So this is the example here for that. So let's say the start point is an investor who's investing, let's say 1 million with a time horizon of 5 years, and given that they're investing at an early stage, their expected return is about 40%. The next step there is to then move to year 5, because year 5 is your target exit. You would tend to value the company on year 5 based on their expected profits or expected revenue or expected EBITDA or whatever, depending on the nature of business. You will look at maybe what kind of multiples are there which are commanded today based on similar businesses, and maybe apply that, and then arrive at some kind of broad value benchmark. What is the expected equity valuation of the company in year 5? Now that is the total value of the company and at the end of year 5. However, this 1 million profit also is going to be achieved only if the company continues to raise more funds between now and year 5. So what you need to do is you need to kind of estimate what is the funding requirement for the company in these 5 years. And based on that funding requirement, our dilution in the stake is going to take place. So that needs to be deducted here to come to what is the value that gets ascribed to the current investors, right? So that calculation is again another estimation in this kind of calculation, where you look for, you can see there investor 1 is where you are putting the money 1 million as of now, which is year 0. And investor 2 and 3 are future funding rounds that are required for the company to achieve the expected year 5 PAT. So 1.5 million and 2.25 million in year 2 and year 4 are the expected fundraisings. Now, each of these investors at different stages of the business will have a different return expectation. Ours is obviously the highest because we are investing at an early stage here, investor 1. As the company grows and becomes more and more stable, the return expectations will also kind of tend to taper down. So let's say investor 2 invests in year 2, he will, let's say, for an example, have a return expectation of 30%. Same for investor 3, who will, let's say, require 25% from year 4 onwards. Based on these numbers, you have a value expectation of those investors at the end of year 5. So 1.5 million of investor 2 at a return of 30% for 3 years is effectively 3.3 million at the end of 5 years. Similarly for investor 3. So 3.295 and 2.812 put together have a value of $6 million, 6 million at the end of year 5. What it means is that from the overall company value of that day of year 5, 20 million, you have a 6 million which gets ascribed to future investors itself. So what remains is the value that is ascribable to the first investor who is evaluating this investment today and the founders who were already there prior to them. Now this value is still at the end of year 5. So we need to find a way to get it back to year 0, and that is now going to be based on the return expectations of the current investor. So you have 13.892 million at the end of year 5, which gets present value to 5 for a 5-year period at 40%, which is the current return expectation of the investor. So you have a current post money value of 2.5 million. And if the current post money value is 2.5, and if the current investor is investing 1 million, then he would ask for a 38% stake. That's how this kind of methodology broadly works in the investment framework. This is where you're not able to do so you will kind of observe that subjectivity to some extent is different here. Maybe in a full-fledged DCF, you need to arrive at a lot of assumptions to do let's say 5-year projections. Here, to some extent, it gets diluted because all you're worried about is, let's say, year 5 metrics and the value at the end of year 5. Now, that could be much more subjective in some cases. In some cases, you might tend to have much more reliability, at least, let's say, on the top line, in which case you can look at a revenue kind of multiple in that scenario as well. So this is, frequently used by investors, as I said earlier. Merits of the case is obviously, it's useful when there is some visibility of future numbers. And as I said earlier, it's practically used by VCs to evaluate actually investment decisions. Unfortunately, obviously, as usual, there are some demerits because it is a little bit more subjective due to obviously the fact that you need to project a certain profit or a revenue or a multiple from at the end of the time horizon of 5 years. So to that extent, there is always subjectivity involved. And of course, from a valuer sense, may not be the best fit to use kind of in a regulatory valuation report, but in a way, in a scenario where you're actually kind of advising a client on an investment decision, this is one of the actual methods which are used practically in those kind of scenarios. So I think it's a bit of an overhang here, this method. So anybody has any inputs or questions here, maybe we can pause for a moment. No questions, then should we move on to the next method? All right. DCF, I'm sure everyone here is aware of all the aspects of DCF. So I would want to focus only on what are the differential factors here that we would need to adjust only because we are valuing an early stage company. So there tends to be obviously much more uncertainty in relation to startup cash flows, unlike a normal stable business where you have much more certainty on projections. So you tend to do a lot more sensitivity in these kind of cases, sensitivity, scenarios, all those kind of things to actually put some kind of sense on the assumptions that go in. Also, another important factor is the life cycle of the projections period. So if in a stable business you're looking at taking a 3-year or a 5-year period, in a lot of these startups, if you're doing a traditional DCF, you might need to take a longer period of time horizon because the idea of terminal value has to be at a period when the projections have reached a stable state of operations. So it might need to be extended, even if the management can, let's say, foresee for the next 4 or 5 years, you might have to extend it maybe for 2 or 3 years more, depending on where the business is likely to, when the business is likely to stabilize. And of course, discount rate must reflect the riskiness. So obviously, discount rates are going to be much more higher than, let's say, a normal stable kind of business. Some indication of what could be typical discount rates. Now, this is not a sacrosanct rule here, but just part of a publication that we've shared there as a source. These are basically indicative rates which people have observed over a period of time. So if you're looking at an angel investor investing really much before, just at an idea stage, they would really need a lot more return, right? 50-70%. Whereas if you're looking at a startup which is more closer to, let's say, the next big fundraising round or closer to an IPO, it might be even 25%. But as you see there, depending on each stage, typically the discount rates will come down as the company crosses each and every stage in the growth portfolio. Yeah, this is very indicative and just a general ballpark range. For Chicago is again another method which is more as a derivation from the DCF itself. It comes from the fact that it is very difficult to arrive at one set of certain cash flows, right? Very difficult to say this is the realistic projection in case of a startup, which is why you go one step further. You identify different scenarios for the business. In most cases, these are three scenarios. One is a normal realistic scenario, the other is a best case, and the other is a worst case. And then you do a projected cash flow and a valuation of DCF under each of these projections, under each of these scenarios. You again do a probability weighted for each of these scenarios, what you think is the estimated probability of the scenarios occurring, and then you do a weighted value similar to what we saw earlier for distressed. So a simple example, if you have a worst case DCF, normal case DCF, best case DCF, you then assign probabilities to each of these values, each of these scenarios occurring, and then the final value will be the weighted value based on each of these scenarios. It's basically a variation of the DCF method itself, but a little more sensitivity oriented. Obviously, the advantages here are that it does take care of the uncertainty involved in startups by way of accounting for it through various scenarios. And because of that itself, it's very flexible because, for example, when you're doing a scenario on the worst case, I mean, you can counter or you can incorporate whatever factors are expected in that kind of scenario, like let's say demand doesn't pick up or cost increase. So in that sense, it is much more flexible than say any other methods. Whereas the disadvantages obviously revolve around things like probabilities. They tend to become subjective, like someone asked earlier. I mean, there is no real basis. It's going to be still based on assumptions, based on your say discussions with the management, your comfort level on the projections, your comfort level on the stage of the business itself. And more so, another disadvantage is when you're looking at these kind of scenarios, worst case, best case, and normal case, we as valuers, we need to go and deep dive one step further to understand the industry dynamics, because in each of these scenarios the idea is actually to incorporate the expectation that if things don't go well or if things go very well, then this is how the business will kind of pivot, and that requires a much more detailed understanding of the business as compared to, let's say, if there is only one scenario. So that does kind of sometimes tend to be a hindrance, but there is always a way to it. You can deep dive further and kind of understand it in further detail. The last method under the startups framework could be score or rank based. This is basically a bucket where I tried to cover 2-3 different ways of valuing. All of these are really high level and crude, and again not the best not best fit from a regulatory evaluation perspective, but more as a ballpark or a thumb rule to say what could be a reasonable indicator when there is lack of information available. So obviously a lot of these are more applicable to pre-revenue, because the moment they are revenue generating and they have a financial track record, then you would tend to look at more of the traditional methods to value startups. Some of these methods also just give value based on qualitative metrics. What is the management team, what is the product stage, whether the prototype is ready. We'll cover that in the next few slides, but these are qualitative based methods. In fact, some of these methods in this also tend to derive the valuation based on what is the absolute valuation of, let's say, other comparable companies, without getting into say their revenues or our revenues, because everyone is pre-revenue. But you tend to look at, let's say, if a startup in the sector was valued at 1.5, you pick up that 1.5 as a start point and then start adjusting for various differences. So it's very qualitative based in that sense. So as I said, I mean, it considers various factors. These are some of the key ones. It considers the idea of how good it is, how good is the management, whether the company has a go-to-market strategy ready, whether the product is already out in the market, and how does a company plan to take it forward going forward. So all of these factors are considered. We'll cover a few examples on how these are usually looked at. This is a method called as a Burkas method, I mean, which is purely based on value drivers of the business. It has identified 5 key value drivers. How sound the idea is, what is the quality of the management, whether the company has any strategic alliances for the business, whether the product is ready at a prototype stage or not yet, or is it still being developed, and what is the rollout plan that the company has. As you can see, each of these factors is related to a different risk. It's either a technology risk or a production risk or a market risk or a execution risk in that sense. And then what this method does is it puts a cap in terms of USD million. It puts a cap that for each of these, if each of these were good and achieved till now, then there is a cap of, let's say, $500,000 for each of these. As you can see, most of these methods are global based, and hence you will find dollar benchmarks here, which are typically even increasingly used by Indian investors as well, but again very qualitative. So this is the cap, and then you go one step further and see in your own company how good is the idea. Is it good, or is it still being they're just about there and thereabouts? Then you would tend to say, no, I should not be 500, I should be 300. If you think that you don't have a strategic alliance or a go-to-market strategy, then the value there should not be 500,000, it should be say 100,000. If you think there is no rollout plan today, it is too early for that, so there is still a lot of say risk of how we will end up producing the products and all of that, then the value ascribed in the last row is much lower. So basically it's an arbitrary way to actually ascribe benchmarks to each of these and then come up with a value. So against a 2.5, which would be a company which has achieved all of this company in your case will be valued based on 1.15 billion. And each of the above numbers will be based on your subjective assessment of how each of these value drivers are at which stage they are for your company as compared to a proper company which has already been there and done that. Another illustration could be risk based. Like I said, starting point in these kind of cases is the pre-money absolute valuation of another industry peer. So let's say there are 3 companies in a similar sector who recently raised funds and have been valued on an average at 1.5 million. Then you directly take that $1.5 million as a start point, and then you lay down certain risk factors. So as you can see, each of these risk factors here is then rated as to what should be a rating, 0 or -1 or 2. And then under this method, what is done is that for each rating, for each positive rating, $250,000 is added, and each negative rating, $250,000 is reduced. So in the first risk, if you see rating of 2, which is why it's 250,000 into 2, so $5 lakh gets added to that. So on an overall basis, you will then ascribe risk for all of these factors, ascribe ratings to all of these, and on a net basis here, you end up adding, let's say, $250,000, which means your company, you will assign a value of say 1.75 million as compared to an industry of 1.5. Say in this case, the primary thing comes from, let's say, lower management risk, which is why your management is rated better than the others. Your technology, let's say, is much better than those other 3 companies, which is why your technology rating is 3 here. Whereas your sales and marketing rollout plan is probably not ready, which is why the rating there is negative, and hence you are commanding a lower value, 500,000 minus there. So all of these are qualitative factors where you will need to spend more time with the management to understand each of these factors and then come up with your own subjective assessment of the rating. The other third option under the score rank based is the scorecard based method, which again starts with an industry pre-money value, an absolute number based on, let's say, 3 or 4 other deals in similar space. And then you identify certain key 5-6 aspects of the business which are ascribed weights to start with. For example, if the management, what is the strength of the management team, what is the size of the overall opportunity, those kind of factors are given and weights are ascribed. As you can see, the total there is 1, which is 100%. So these weights are the start point, and then you go one step further and see the company that you are valuing. How good is that management? Let's say in the first one, is the management team better than, let's say, those 3 other companies? If yes, you would, let's say, put a factor which is higher than 1 there. Whereas if the competitive environment, let's say, is similar to those companies, so you've put a factor of 1 there in the fourth row. Based on these factors, your assigned factor gets calculated based on, let's say, the first one, it's 0.3 into 1.5 times, so it's a 0.45. So on an overall basis, on a total basis, you're at a factor of 1.19. So how you arrive at your company is again, say, $1.5 million into 1.19 total factor, which gives you a $1.78 million your value. So these are all, typically used just as a ballpark indicator of, what should you generally pay for this kind of company. Another could be even stage based, where this is again, just an indicative thing without getting into the specifics. People tend to assign values based on what stage the company is at. Say if it is an exciting, it's only at an idea stage, then it is lower than $500,000. If it has a management team, then the final product is ready, then there is a strategic alliance, and then there are indicators of growth. So as you can see, at each of these stages, the value assigned tends to increase, and that just gives you an indicator of, what could be the range under which the value might lie. This is again coming from a recent publication. As I mentioned earlier as well, these kind of methods, score and rank based, they are all based on qualitative aspects. So to that extent, they're used in most cases where pre-revenue companies are there, and obviously you don't have any financial track record. And given that they're all qualitative, obviously a little more subjective, in fact, much more subjective. And in some cases, it also just puts an arbitrary cap, like in the first one that we saw in case of Burkas. 2.5 million was an arbitrary cap, irrespective of where you are. So those kind of limitations are always there when you use these kind of methods. So if we were to just broadly kind of summarize those 6 methods, 6 approaches or methods that we saw, and kind of tend to bucket as to whether there is a subjectivity or judgment involved, whether it's a highly subjective method or is there low subjectivity. Anybody has any thoughts on whether, let's say, price of recent investment, whether the subjectivity would be high or low, and whether it can be supported by evidence or not? Anybody? In fact, for each of these methods. Less subjectivity. Yes, relatively low subjectivity. That's right. And in fact, as you move along in the chart, what you will see is that the top 2, which are, let's say, price of recent investment and comparable transactions, there is very little subjectivity in those approaches, and also your supportability from a market perspective is very high. Whereas the next 3 that you see there, variations of DCF in some sense or the other, venture capital to some extent, and First Chicago to a larger extent, all of these have some kind of subjectivity, but there is some backing or thought to that in terms of the approach. So I would put it in the medium bucket there. Whereas the last bucket that we saw, which is score or rank based, it's highly subjective, and you really have not much evidence to actually support whatever value conclusion you come to. So in terms of even hierarchy or preference of using methods, I think that's the order in which we would tend to go. Initially look whether there are any transactions in one company. If not, you would look at transactions in similar space in other companies. And then if not, then maybe you look at all these other variations one by one, depending on where the business is, availability of information, availability of projections, and things like that. So we're done with startups. Anybody wants to discuss any aspects of startups, or should we move to the cyclical ones?
Sir, am I audible?
Yes.
Yeah. So in case of venture capital method, if we use different scenarios, okay, would that
Which
reduce the
method?
subjectivity? In case of venture capital method, if we use different scenarios, let's say different rate of return, expected rate of returns, and different revenue growths,
Yeah.
using different scenarios would reduce my subjectivity, or again that would again be an assumption only, so it would would not make any difference in
No,
the.
I don't think it will reduce the subjectivity. All it will do is, for you to get some more comfort on the final value conclusion. If under different scenarios, if the values are similar, then that will just give you some added comfort in terms of the final value conclusion. But subjectivity in that sense would still remain, because all of these are still assumptions, right?
No, my value would change, right? If I'm using different assumptions, set of assumptions, my value under different scenarios would be different. So maybe if I take an average of those values, let's say, wouldn't
Yeah, yeah.
that
So no, values will change. What I was trying to drive is that the idea of doing a sensitivity, maybe in a method like a venture capital, is to try and find out that if, let's say, the revenue was different, or if, let's say, instead of say a P, you use a revenue multiple, or let's say instead of 40, use a 35 or a 50 or whatever. I mean, how different is the value, right? That could be the objective to do that sensitivity in that kind of scenario. So point I was trying to drive is that if the values are not very different in those different scenarios, or if your base case value is not very different than, let's say, the average of 3 scenarios, then it is only going to give you added comfort on the conclusion. That's all. But the underlying subjectivity will still remain in terms of, say, a return expectation of a 40% or a P multiple of 20x 5 years down the line, right?
okay, understood, yeah. So since there's no backup or supporting for those assumptions, again, that's why we call them assumption. That's why we are saying it would be subjective.
Yes. So in some cases, what may happen is that if you look at current benchmarks for, let's say, P multiple for profit-making companies, and if you tend to, arrive at a conclusion that P multiple should be anywhere between, say, 15 to 20, that might be a good, case for you to do what you're saying, that you do two methods, one at 15x and one at 20x, and then see where you lie in between, right? So where you're not able to kind of come to one number with a relatively high comfort on assumption, there you would tend to look at more scenarios.
Understood. So just on a similar note, for the P multiples that we use, if we, so there's no defined criteria, as in you use the trailing P or a forward P. Okay. So what would be an ideal case, as in maybe there would be a 6 months prior P, trailing P, 3 months trailing P. So then in that case, for a normal DCF value, or for a normal company, okay, with matured cash flows, I'm not talking about any of the cyclical or special situations companies. So in that case, what would be a good practice to do? As in, you take a forward P or trailing P, or you take a average of, let's say, 3 months, 6 months, 12 months trailing Ps.
See, for a matured company with a stable business, the most traditional way to do it is based on a trailing 12-month P. So based on profits of your last trailing 12 months. Because if you're matured and if you're stable, then you essentially don't need to look at, let's say, a different run rate, or let's say the next year profits or anything of that sort, right? So for a stable business, the most common way to do a PE is based on trailing 12 months.
Okay, but then no, my question was also in the scenarios like in the previous 12 months, let's say there's a PE expansion that is happening. Okay, if I take a PE which I'm applying to the IT companies pre-COVID, and a PE that I'm applying to IT companies post-COVID, there's been a PE expansion.
Yeah.
Okay, so will that, applying that P, expanded P to the IT companies, would that be sustainable if I'm just taking a 12 months trailing P?
No. In any case, what you're trying to achieve is current value benchmarks based on current market rates, right?
Correct.
So let's say if not in IT, maybe in some other corollary, if you were to look at, let's say, why the P multiples have increased, it could be also a relative of the fact that profits might be lower now, but market cap has remained the same, right? So
Right.
even in those cases, the P multiple might look high now. But the point is, once you use that as a start point, and when you're applying that to your own company, assuming your company is also following the industry trends, your company's profit also is likely to be lower. So on an apple to apple basis, as long as you're doing consistent basis, you should be fine, because there also the multiple is high because of low profit. you apply that to our profit, which is also low. So you're on a like-to-like basis. As long as you're consistent in calculating the multiple and applying it, it should be fine, I guess.
Okay. Okay. Yeah. Uh,
Yeah.
on the same question, if you want to make any adjustments, typically based on the company, let's say my EBITDA margins are higher than my comparable company. So how would you do the adjustments in that case for the multiples, let's say EV upon EBITDA? Or
So adjustments will always depend on all the differences in both the companies. Say if there is a size, if your company is smaller than them, then you tend to look at some kind of discount for that multiple. If you're looking at a revenue multiple, and if the profit margins are very different, then you tend to look at a discount or premium for that on the revenue multiple. If you're looking at listed companies as a start point, and if you're valuing your unlisted company, then you would again apply something for the fact that your shares are not traded. So for each of these factors, you will compare apple to apple and then do either a discount or a premium. How much discount or premium you take will all depend on your judgment of that. It could be a 10%, 20%, 25%, whatever.
basically, the adjustments would be subjective, and there's no defined guideline as such.
No, you will not
Okay.
find any guideline which will give you how much discount to take or how much premium to take. It has to be subjective. Yeah. Yeah. Anybody else? All right, then let's move on. Cyclical companies, typical characteristics of these companies are usually where, because of the economic trends, they tend to move up and down based on where they are in the cycle. So when there is actually prosperity and those kind of things, your revenues will be higher, whereas when there is a downturn in the industry, your revenues will be lower, right? Now, how do you identify whether your company is cyclical or not? Generally, you will need to do, at a larger level, look at which sector it is and whether that sector itself is cyclical or not. And then whether your company is following the trends of that sector. If it is, then effectively you're ending up valuing a cyclical business. And for this to happen, you need to do some more analysis of the past trend to kind of study the company's own track record, own history and trends, and to see whether they've been performing in line with this, how the cycle is operating in that industry. If yes, then that is where you establish for yourself that yes, this is a cyclical business, and then what are the adjustments that you need to do while arriving at their valuation. Methods here are actually very similar to what we saw or were trying to counter in the distress section. So, but with slight refinements, obviously, given the fact that these are cyclical but not under distress. So again, under the income, you have two options. One is you normalize everything under the DCF concept itself, or the other one is that you do a adjusted DCF based on the fact that wherever they are in the cycle. Multiples as well, you have the option of normalizing everything, or the other one is the adjusted multiple, where you have the option of doing it based on where they are in the cycle as of now. So we'll cover each of these. Under the normalized DCF, what happens is that you need to estimate the normalized level of operations and earnings of the company, right? How can that be done is you can look at if they are, let's say, at a low point in the period right now, or maybe even at a high point. You need to take an average over the period, maybe over the life of the last cycle or whatever, and then look at what has been their, let's say, normalized revenue over the period of time. That then gets used as a start point for your projections, and you assume that everything will be normal throughout the DCF. So that can be done at different levels. It can be either done at revenue and then float down to profit, or it can be done at margin level, where you can look at what were their average margins in the past and then kind of use that to project the estimated numbers based on the average. Even better way for that could be to look at what has been, let's say, average industry margins over the last, let's say, last cycle, entire cycle, and then you can use that as a normalized indicator and kind of use that in the projections as well. Important, irrespective of all the above, most important is that the length of your projections should typically cover one full cycle. So that is when all of these adjustments tend to make sense. So if the cycle in the industry has been observed to be, let's say, 10 years, you would tend to look at, let's say, a 10-year horizon in the projections. And then Once you estimate all of the above and the projections based on that, then it's like a normal DCF that you arrive at based on the normalized projections. The other option, as we spoke of, was adjusted DCF. And the premise to this method is that normalizing everything for the entire period may not be the right way to do it, because if you're at a certain point of time in the cycle, then that cycle would ideally be better reflected in the projections itself. So for example, if you're at a peak right now, if the company is at its peak, then the projections will actually reflect, let's say, a decline or lower growth or lower profits or things like that going forward. Whereas if the cycle is currently at a low point, then the projections will reflect the growth based on the past trends of the industry and the company, like we saw on the earlier slide. However, obviously another refinement here is that the terminal value in these kind of cases would still need to be based on a normalized thing, because at the end of the day, once you're covering projections for typically a full cycle, then after that, for the terminal value, what you need to look at is not the last year of the projections, which could be, let's say, the peak or the low point, but a normalized level, which could be an average of an entire cycle, and then that gets used to capitalize for the purpose of terminal value. We go on to multiples again. As I said, two options. First one is normalized multiples, where you look at comparables or identifying comparables who are also in the same cyclical sector and the same stage as what your company is. Once you do that, then you can either do it based on, say, listed companies or even based on, say, transactions in unlisted. And here, under this approach, the multiples get calculated also based on normalized earnings. So when you're looking at, let's say, a listed comparable, you have their market cap, but the multiple that you will tend to derive would be based on, let's say, their average normalized revenue or normalized profit or whatever. So you have a normalized multiple there. Once you do that, you apply that normalized multiple to your own earnings, and that earnings also has to be a normalized number, which has to be, let's say, an average over the last cycle or so. Obviously, adjustments will always be required, just like a normal comparable company between, say, listed comparable and your own company. But the most difficult, challenge in trying to adopt this kind of approach is, obviously, it's very difficult to estimate normalized earnings, not only for your own company, but more so for the comparables, because that kind of data also needs to be available, especially if you're using, let's say, unlisted comparable transaction as a basis benchmark. Listed companies, you might be able to find it still. So since normalization may not always be possible and may not be always the best way, again, adjusted multiples is a way where you can try and reflect where you are actually in the cycle today. It's based on the premise that market prices actually reflects that kind of stage. So for example, if you're in a phase where your profits are high, your P multiples are effectively low to that extent, right? I mean, this is very similar to the point that we just now discussed with Mr. Mihir Shah as well. So whereas if you're in a phase where your profits are low, your P multiple might look actually high. So you use that as a start point, and then while applying as well, you're going to be applying them to your own metrics, which are either high or low in line with the same industry. So to that extent, both are on an apple-to-apple comparable level, and you're doing things on a like-to-like basis. And of course, general adjustments that you need to do for CCM are always going to be there for company specifics. So we can move on to investment entities unless someone has any points on cyclical. This is just a couple of more slides now. So let's move on to investment entities. So actually, to be very frank, there is no specific, additional refinement or change to the underlying approach of any valuation just because the company is an investment company. The only difference being that the end company that you end up valuing does not have its own operations, and it is actually deriving its value from its underlying investments. But few key things to keep in mind is that if the underlying investments are in different sectors, then each of those investments will have to be valued based on valuation metrics applicable to those respective sectors. Similarly, if each of the investments is having a different stake, then your choice of valuation method also may have to be different for each of the underlying investments. So if you have, let's say, a controlling stake in one company, you might be able to use a DCF, but maybe in another company you have only, let's say, a 5% or a 10% stake, and you may not have access to projections as well. in which case you may have to use more like a market multiple kind of method in those kind of cases. So these two become the crucial, selection criteria as to how you differentiate within the investments per se. And then all of those will be added up, and the sum of those will actually go and arrive at the value of the investment company. Obviously, key factor like we spoke of earlier is the holding company discount, and frankly, that is the only major differentiator when you value any investment company. I mean, it comes from the fact that two things. One is the company derives its value from investments. Second is the company cannot realize the value of its investments generally without a leakage. So how would the leakage happen is that if you realize the value, let's say through sale, if the company were to sell the investments, somewhere or the other, there's going to be, let's say, a capital gains tax implication. There might be some transaction cost, brokerage or whatever, right? And if it doesn't sell, what is the other way of realizing the investments? Could be, let's say, through a dividend or through a buyback. Each of these modes are now plugged with a tax leakage, right? It could be a dividend tax, or it could be a buyback tax, or whatever. But the point is that if they were to realize that value, then in most cases, more often than not, there is going to be some leakage of value. So that leakage is effectively giving rise to things like a holding company discount, because the holding company then tends to trade at, or for that matter, command a value which is lower than the sum of the parts of the investments. Now, how do you factor this in? There are, two ways to look at it. One way is you do it by way of a general discount of, let's say, 20-30% or whatever that number is, based on, let's say, comparable companies. If you're aware of investment holding companies, let's say like a Bajaj or whatever, and if you're able to ascribe, say, a value of underlying investments based on their respective market prices, you tend to look at their differential and arrive at what is the discount that the company is trading at, similar to what you do for, let's say, a differential voting right share. The other option is to look at it more as a realization concept, where you say that these are the underlying investments. If you were to sell those, you will end up paying tax, which could be like a notional capital gains tax or whatever. So you take that tax while valuing the investments, and then net of tax is what gets parts of the investment value. So that's a more frequently used method, especially from a regulatory sense, rather than an arbitrary discount. And that's the only factor which actually needs to be taken care of while valuing an investment or a holding company. So that's broadly it from my side. Any other points happy to take, or any inputs, any specific ones that anybody wants to discuss, any situation, scenario points?
Dave, hi, this is Valmik. I had a question.
Yeah.
And I've asked this to some people, but I've never got the answer. So what is the difference between fair value and fair market value? And a lot of people use it interchangeably. Can it be used that way?
Yeah, to be very frank, it is almost as if it's interchangeable only. So, in India, you will find both definitions are same, almost same. It's basically a market value itself. You're doing market related assumptions and taking that, right? So it's as good as the same from a practical sense.
And Valmik, just to add to what they mentioned, typically the definition is like that whenever you are doing an accounting based valuation, all the accounting standards and all the guidelines define it as fair value. But when you are doing a valuation under, say, income tax, they call it as fair market value, right? So there is a slight difference in terms of the theory per se, but in terms of the practical part, it is more or less the same. It talks about the same thing, which is that it has to be a value which is between a willing buyer and a willing seller under no stress situation, right? Only thing is the nomenclature in terms of for which particular regulation you are doing that valuation.
Sure,
So is
I
that
understand.
the same answer you
Yeah.
received from other people also with whom you checked?
Not with so much clarity. I don't think they even realized that FMV was kind of described in the Income Tax Act. I think it's defined there, right? If I'm
Yeah, it's
correct.
defined. So they everywhere, if you see, income tax uses the word fair market value, whereas anything related to accounting guidance or regulation, they use the word fair value.
Yeah, correct. So in IBC also is defined as FV, not FMV. Yeah, you're right.
Yeah.
Thanks for the clarification.
Anybody else? Anything? Hope the session was useful.
Yeah. So do we have any questions, or should we end the session? All right. So Dev, can I request you, because you are also part of that valuation group, can you share this presentation on WhatsApp in that group? Because we
Yeah,
had
yeah.
requested, got a request from someone saying that it takes some time to get the presentation, so you can directly send on the group itself,
Sure.
right?
Yeah.
And Rushabh, can I request you to give the vote of thanks, please?
Yeah, surely, same. So thank you, Devarajan, for the wonderful presentation. Coincidentally, it seems like today is a good day for all the devs, be it Devarajan or Devendra Fadnis, on a lighter note. But what a wonderful way to start off the study group. Thank you, Devarajan, for taking this up, and we look forward to such more sessions in the coming times. So thank you everyone for joining in, and we'll look forward to meet you again soon in the next lecture.
Thank you, everyone.
All right. Thank you. Yeah.
Thank you.